Governments often claim they're working to improve your financial future. They speak about stability, economic growth, and creating new opportunities. But if you take a closer look at history, a very different picture begins to emerge. For centuries, governments have relied on financial strategies that quietly weakened the wealth of ordinary people while concentrating money and power in the hands of a smaller group. The surprising part is that these strategies are nothing new. They've simply been repackaged throughout history. The names have changed, the presentation has changed, but the objective has remained remarkably consistent: move wealth upward while keeping most people financially dependent on the system. Let's begin with the oldest and perhaps the simplest example of all: inflation. Whenever a government spends more money than it collects through taxes, it usually faces two choices. It can openly admit the problem and increase taxes, which is rarely a popular political decision, or it can quietly reduce the purchasing power of its currency, making every coin and banknote in circulation worth a little less over time. Ancient Rome became one of history's best examples of this approach. As military expenses continued to rise, Roman emperors gradually reduced the amount of silver contained in the denarius. A coin that had once been made almost entirely of silver slowly turned into little more than copper, covered by a thin layer of silver. On the surface, everything appeared normal. The coins still looked familiar, but everyone who earned them, spent them, or saved them eventually paid the price. Prices climbed rapidly. Savings steadily lost value. Wages struggled to keep pace with the rising cost of living. In reality, it functioned as a hidden tax placed on the population. Today, the mechanism may look different. Imperial mints have been replaced by central banks. Yet the underlying principle remains strikingly similar. During the Middle Ages, another version of the same idea appeared: forced lending. Kings in England, France, and Spain regularly pressured wealthy merchants and trade guilds to provide money to the crown. Officially, these loans were described as voluntary. In practice, refusing often meant heavy fines, confiscation of property, or even harsher punishment. Sometimes the crown promised to repay the money with interest, but repayment frequently arrived years later in currency that had already lost much of its value. In other cases, the money never returned at all. Meanwhile, governments continued financing wars, expanding royal courts, and strengthening their authority. Merchants were left with very little choice but to surrender their capital. The real trick was presenting coercion as patriotism and civic responsibility, and for centuries, that strategy proved remarkably effective. By the 17th century, the financial system itself had become part of this mechanism. The creation of the Bank of England wasn't simply about improving banking. Its primary purpose was to help the government raise money for its wars against France. Wealthy investors purchased government bonds, and in return, received reliable interest payments backed by future tax revenue. At first glance, the arrangement seemed perfectly reasonable, but one important question remained: who actually paid those taxes? Ordinary people. They paid taxes on everyday goods such as salt, beer, cloth, and countless other necessities. The wealthy earned dependable returns by lending money to the government. Those returns were ultimately financed by the taxes collected from the public. What appeared to be a normal public finance system also became a mechanism for transferring wealth from the broader population to those who already possessed significant capital. And interestingly, that pattern hasn't completely disappeared. Even today, lending money to governments is widely considered one of the safest investments available. The returns earned on those investments are still supported, in the end, by the work, spending, and taxes of millions of ordinary people. Fast forward to the modern world, and these financial strategies haven't disappeared. They've simply taken on new forms. One of the clearest examples is deficit spending. Governments borrow enormous amounts of money by issuing bonds that are purchased by investors, banks, pension funds, and even foreign governments. The public is usually told that this borrowing will finance infrastructure projects, create jobs, or improve public services. And while some of it certainly does, a significant share often finds its way into defense contracts, corporate subsidies, or large financial rescue packages. Eventually, the bill comes due, but instead of reducing spending at the top, governments frequently choose other options. They raise taxes, they allow inflation to reduce the real value of the debt, or they reduce public benefits and social spending. The debt may have been created in the name of helping the public, yet the financial burden often falls on ordinary citizens, while many of the financial rewards flow to those who own the government bonds. Another powerful example is the financial bailout. During the global financial crisis of 2008, many major banks took enormous risks by packaging weak mortgage loans into complex financial products. When those investments began collapsing, the entire financial system came dangerously close to failure. So who ultimately paid the cost? Taxpayers. Governments stepped in with massive rescue packages funded by public money. And who benefited once the crisis had passed? In many cases, the very same financial institutions that had contributed to the problem emerged even larger and more powerful than before. The pattern was straightforward. Profits remained private, losses became public, and society was told these extraordinary measures were necessary to protect the economy. Retirement Retirement and pension systems offer another example of how financial realities are often hidden behind reassuring promises. For decades, workers in countries such as the United States, the United Kingdom, and many parts of Europe have contributed money into government-managed pension systems with the expectation that those funds would support them after retirement. What many people don't realize is that governments often don't set that money aside for the future. Instead, much of it is spent almost immediately on current government obligations. In its place remains little more than a promise that future taxpayers will cover the costs. In many ways, the system depends on each new generation financing the promises made to previous generations. As long as enough workers continue paying into the system, it functions. But when populations age and birth rates decline, the pressure grows. Eventually, governments are forced to reform the system. That usually means reducing benefits, increasing the retirement age, or allowing inflation to quietly reduce the real value of future payments. If you step back and look at these examples together, a clear pattern begins to appear. The success of each strategy depends largely on perception. Inflation is presented as economic growth. Forced lending becomes a patriotic duty. National debt is described as investment. Financial bailouts are explained as necessary for stability. Pension reductions are introduced as reforms. The language changes. The presentation changes. But the underlying outcome often remains the same: a gradual transfer of wealth from the broader population toward those who already control the greatest financial resources. History suggests these strategies have remained effective for one simple reason. Most people never spend much time studying economic history. Many don't fully understand how financial systems actually work, and by the time they recognize what's happening, the consequences have often already begun. Over the last several decades, these financial strategies haven't disappeared. They've become even more advanced. A good example is quantitative easing. Before the financial crisis of 2008, very few people had ever heard that phrase. Then, in response to the crisis, central banks created trillions of dollars electronically and used that newly created money to purchase government bonds and mortgage-backed securities. Officials argued that these extraordinary measures were essential to prevent the financial system from collapsing, and to a large extent they succeeded. Financial markets recovered, stock prices climbed sharply, real estate values increased, bond markets stabilized. But an important question remains: who benefited the most? For the most part, it was those who already owned significant financial assets. People with large investment portfolios saw the value of their wealth rise dramatically. For the average household with little exposure to stocks or other investments, however, the gains were far less noticeable. Instead, many families experienced higher housing prices, increasing living costs, and markets that became more difficult to enter. In effect, the newly created money helped stabilize the financial system while also contributing to rising asset prices and widening wealth inequality. Another example is hidden taxation. Rather than raising income taxes in obvious ways, governments often increase revenue through methods that attract much less attention. Sales taxes, fuel duties, various indirect fees, and perhaps the most effective tool of all, inflation. When the cost of living rises faster than wages, purchasing power quietly declines. Savings lose value. Paychecks buy less. Although few people think of it this way, the result functions much like an invisible tax. Governments generally benefit because inflation reduces the real burden of the debt they owe. Citizens experience the opposite. Their money gradually loses buying power. A larger paycheck may create the impression of becoming wealthier, but if prices are increasing even faster, real wealth is actually shrinking. For that reason, many economists argue that inflation is not simply an unfortunate side effect of the economy. It is also a policy tool that can quietly shift part of the government's financial burden onto the public without openly announcing higher taxes. Another important concept is regulatory capture. On paper, regulations are created to protect society. Financial rules, consumer protections, safety standards. Their purpose seems straightforward. Yet history repeatedly shows that industries with enough influence often shape the regulations that are supposed to oversee them. Railroad companies did it in the 19th century. Oil companies gained enormous influence during the 20th. Today, many observers argue that major technology firms and financial institutions exercise similar influence. The pattern rarely changes. It's often easier to influence the referee than to compete under perfectly equal rules. Governments introduce regulations that appear to protect the public interest. Meanwhile, powerful corporations frequently secure favorable exceptions, legal advantages, or loopholes that make competition much harder for smaller businesses. From the outside, the system appears more protective. From the inside, it often becomes another mechanism that strengthens those who already hold the greatest economic power. War financing is another example of an old strategy taking on a modern appearance. During both World War I and World War II, governments issued massive amounts of war bonds and encouraged citizens to purchase them, presenting it as a patriotic responsibility. People People truly believed they were helping their country, and in many respects they were. At the same time, however, those bonds became highly attractive, low-risk investments for wealthy individuals and financial institutions because they were backed by future tax revenues. Even today, the overall pattern remains remarkably similar. The wars in Iraq and Afghanistan were financed largely through borrowing. That borrowing generated enormous profits for defense contractors, financial institutions, and bond investors, while ordinary taxpayers ultimately carried the long-term financial burden. Wars are almost always described as temporary emergencies. The debt created to finance them, however, often remains for decades after the conflict has ended. Governments also use complexity itself as a financial tool. Tax systems span thousands of pages. Financial products become so complicated that even experts sometimes struggle to explain them clearly. Government budgets are filled with technical language, hidden allocations, and specialized terminology that most citizens never fully understand. As a result, following the movement of public money becomes extremely difficult. Complexity becomes a form of camouflage. When people can't easily see how wealth is being transferred, they're far less likely to question it. In ancient Rome, citizens could physically see that silver coins were gradually being replaced with cheaper metals. Today, similar changes are hidden inside balance sheets, technical reports, abbreviations, and highly complex financial programs. The method has changed, the principle has not. The more difficult the system becomes to understand, the easier it is for major financial decisions to take place without attracting public attention. Why does all of this matter today? Because these patterns haven't disappeared. If anything, they're becoming even more widespread. Inflation continues reducing the purchasing power of savings. Government debt keeps reaching new records. Financial bailouts remain a common response whenever markets begin to struggle. Central banks continue influencing the money supply. Meanwhile, many of the costs are quietly passed on to ordinary people through mechanisms indirect enough that most never notice the connection. The result is a system where millions work harder every year while finding it increasingly difficult to build lasting wealth, even as major financial institutions and large asset holders continue strengthening their positions. History teaches an important lesson. These financial strategies rarely vanish. They simply return wearing different clothes. When Rome reduced the silver content of its coins, ordinary citizens suffered. When medieval rulers relied on forced loans, merchants carried much of the burden. When modern governments depend on borrowing and inflation, households often pay the long-term price. Different centuries, different technology, but remarkably similar patterns. Perhaps the harshest reality is that many people never realize these mechanisms are operating around them. Inflation starts to feel normal. Taxes seem unavoidable. Financial rescues are accepted as necessary. Government messaging replaces historical understanding, and that lack of awareness may be the most effective financial strategy of all. When people stop understanding history, they also lose the ability to recognize when those same patterns return. That's exactly why financial education matters. Understanding economic history doesn't guarantee protection, but it makes manipulation far more difficult. So what should we take away from all of this? First, always look beyond the headlines. Whenever governments announce stimulus programs or major economic plans, ask who benefits first and who ultimately pays the cost. When inflation rises, don't automatically assume it's simply bad luck. Policy decisions often play a major role. When new regulations appear, ask who helped write them and who stands to benefit the most. Second, focus on building real wealth instead of relying entirely on money itself. Assets that preserve value over long periods have historically provided greater protection whenever monetary systems weaken. Finally, never assume that any system automatically exists to protect your interests. Every institution naturally works to preserve itself. Recognizing that reality allows you to make wiser financial decisions. History never repeats itself in exactly the same way, but those who ignore its lessons often end up living through familiar patterns without recognizing them. Many of the financial techniques that affected ordinary citizens centuries ago still exist today. They simply come with different names and more sophisticated packaging. The real question isn't whether these patterns still exist, it's whether we recognize them before they affect us. If this video gave you a new perspective, don't forget to subscribe. History still has countless lessons waiting to be uncovered.